Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 71 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think can be really useful for you in your personal financial life. Today, we're going to be talking about something that is pretty sketchy, to be honest, and but I did want to do an episode on it. That way you guys know what they are and what to look out for, and that is the reverse mortgage. I mean, the likelihood that you've seen a commercial sometime in your life that has said, oh, you can have your dream retirement income because of this reverse mortgage. I don't like buying things from commercials, and I think we're going to talk about why and why these may not be the best idea for you and the best use of your home and the equity that you have in your home on today's episode. But before we begin, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback down in the comment section. Also, if you're listening on Apple or Spotify podcasts, make sure that you subscribe there and leave me a review. Follow me on social media at MNO with Dylan. And then if you want to work one-on-one in financial coaching and do a financial coaching session with me, you can go to my website, www.mnowithdylan.com, and click on the Work with Dylan tab and pick the financial coaching session that you think would work best for you. And we can begin working together one-on-one and pushing towards your long-term financial goals. So what is a reverse mortgage? A reverse mortgage is nothing more than a loan on your home's equity that individuals can get if they are 62 years of age or older, typically, and this loan is going to pay you retirement income from your home's mortgage. And this particular type of loan is aimed at the individuals who have either paid off their mortgage, therefore they have 100% equity in their home, or they have paid off most of it, therefore having a lot of equity in their home from which to do the reverse mortgage on. This is really similar to a HELOC in the way that we are taking home equity and we are using it for some loan, for some reason. We are taking that money out of our home, and it's no different really with a reverse mortgage. They're just using this to create retirement income for themselves typically that they wouldn't have had otherwise, but it is still a loan on your home's equity. So with a reverse mortgage, you don't make payments on your home's principal. The bank is paying you payments back from the home's equity, but they are also charging you interest at the same time, which is the weird part of this, is that you're receiving this money, but they're still charging you interest at the same time. And the reason a lot of people find the idea of a reverse mortgage interesting is because they don't have to pay back any of the equity or the interest until they sell the home. So it makes it seem really easy to just go ahead and do this and take the money off of it, especially if they're not going to sell the house. But here's the cringeworthy thing. Here's the thing that makes you go, ooh, I don't like that. If you are to die before selling your home, therefore paying back the reverse mortgage, then what will happen to the people you leave your home to is that they will have two options. They will either have to go about paying off the mortgage with the interest, or they will have to surrender your home to the bank. Neither of which is a great idea, and neither of which is leaving anything substantial behind for your children or any of your heirs. So it might seem like a reverse mortgage is a good option to keep cash flow coming in, but it is a big risk to these homeowners and their heirs as these people go into retirement. There are really only three types of reverse mortgages, and those would be the Federal Housing Administration reverse mortgage, there is the single purpose reverse mortgage, and the proprietary reverse mortgage. And all of these work in similar ways, but let's kind of talk about what the distinct differences are between these three types. That way you will know and know what to look out for. The Federal Housing Administration, or the HECM reverse mortgages, those are given to these individuals who are 62 or older, and these individuals go and they can use the money that they get from the reverse mortgage for whatever it may be. The problem is this, is that if your house is worth more than a certain amount, it could be an issue because the FHA, the Federal Housing Administration, keeps such a tight leash on these particular types of loans, on these individuals, that they want to make sure that they don't default on their loans. They want to make sure that they get paid back. Therefore, what they will do is they won't let individuals of a certain house price or above take out these reverse mortgages. And then the ones that they do, those have to pay insurance premiums. So if you'll remember, like when we were talking about the private mortgage insurance on mortgages, it's a similar thing, because remember the FHA would make you keep that the entire time. Well, in this case, they're going to make you pay these insurance premiums as you have your reverse mortgage. So it becomes really costly to do so. And this insurance, it is not for you, it is for the lender. So you don't get any protection from it. It is simply the lender, in the same way of PMI, the way that is a protection for the lender and not the homeowner itself. And this HECM reverse mortgage is the most common type. It came out in 1988, and it's the most common type that people take out. And these are not going to be much different than the other two types, but the other two have some basic caveats that are a tad different. So we move to the proprietary reverse mortgage. So proprietary reverse mortgages are not federally regulated like the FHA reverse mortgages. Therefore, these have more leeway. They have more that they can work with as far as giving out these loans to these individuals. And because they're not regulated, they can promise these higher loan amounts. They can promise that you'll get more for what we're gonna, what we could offer you, what your home is worth. You will get more for what your home is worth. And the catch is that there are going to be much higher interest rates on these loans. And these are all given out by these private institutions. Therefore, they're willing to take on a little more risk than the federal government is. And these types of reverse mortgages even can allow the individuals to borrow more than they would be able to with the FHA's maximum. So the FHA, like we said, has this certain amount that if you get to it, they're not going to give you a reverse mortgage because they're trying to make sure that they get paid back. Well, these lenders can exceed that amount, and that sounds good for the particular individual, but it can be detrimental because there's just more debt on your home and more debt that either you're going to have to pay back or the people who you leave your estate to are going to have to pay back. Either way, it is more debt on your home, and you don't want that, especially when it can lead to such risk for you and the individuals who you leave your money to. So then lastly, we have the single purpose reverse mortgage, and these differ because if you think about the name, single purpose, they can only be used for singular purposes. And these are given out by states and local lenders and these governmental agencies, and they put the bounds on what you can spend this money on. So instead of just being able to use it for anything like the first two types of reverse mortgage that we talked about, so with this type of reverse mortgage, you can only use the money for property tax payments or home improvements or things of that nature. Therefore, you are restricted in what you can spend the money on. So the main idea of this type of reverse mortgage is that they want to give individuals money so they can stay in their homes if they fall behind on things like the homeowners insurance or property tax payments. They want you to be able to stay in your home. And in a similar way, if you need to make big house repairs, they still want you to be able to stay in your home and not have to sell. So that is the benefit of all this, is that if you did fall to that point, there's always that to run to. But it doesn't make it any safer than the first two types of reverse mortgages we talked about. And since these are just used for single purposes, they typically offer less in the amount that they will give you for however much equity you have in your home. And not only do they offer less, since these loans aren't federally regulated, then there are no mortgage insurance premiums like there was in the HECM reverse mortgage. So then what are the requirements for a reverse mortgage? Because obviously for any type of loan, there should be a particular set of requirements. There are as well for reverse mortgages. So to qualify for a reverse mortgage, first of all, like I said earlier, you must be 62 years of age or older. That's just right off the top. And then you must own a paid for paid off or nearly paid off. So you must have at least a significant pay down on your home because they want to make sure that you have adequate equity in order to do the reverse mortgage. And then you have to have this home as your primary residence. This can't be done on an investment property or something of the like. It has to be done on the residence that you live in. You also must owe 0 federal debts because they don't want you to owe anything to the federal government, especially for the FHA type of reverse mortgage, because they're going to lend you money even more. So they don't want you to have outstanding federal debts. And then you have to make sure that you have the cash flow to continue to cover things like your taxes, your insurance, your HOA fees, continuing home repairs, things like that. And all of these things that we've just said are going to be ways that you could qualify for the reverse mortgage. And it's not just enough to qualify, your home has to qualify as well. And so the single family home, or you can have a multifamily home up to a 4-plex, okay, that you live in one of the residences there, then you can get a reverse mortgage on one of those. But with the HECM program, they will allow reverse mortgages on condominiums as well. And that is something that HUD does, the Department of Housing and Urban Development, something that they do offer because there are a lot of condos and things like that in more urban areas and bigger cities around the U.S. So now let's jump into the distinct disadvantages. And this is something I really want you to be able to hear and internalize and understand are the distinct disadvantages of the reverse mortgage. And so first of all, it's not really a lifeline for you. So let's just use a quick example to help me explain why this is. So you might be thinking about taking out a reverse mortgage and feel confident that you can borrow on your home and that it shouldn't be an issue, and you're not going to use the money on anything wild and crazy. Yet even though it may seem like a lifeline, let's say, just in theory, let's say you have $100 in the bank, okay? And let's say you go to the bank and you want to withdraw the $100, but the bank will only give you 60 of the 100, okay? And then they charge you interest on that 60 from the $40 that you still have in the bank. That seems wild. That seems crazy. Why would you take that deal? But the thing is, that's exactly what a reverse mortgage does. You can tap into a certain amount of your home's equity, and then you pay the interest out of the equity you continue to have. And that is a huge downside. It is not something that you can just hold on to as a lifeline and just get the money. It's not the same as a HELOC. It is different. And then let's also understand that the reverse mortgage is typically riddled with fees. So even though you're going to go get a certain loan amount, you're typically not going to get that full amount because you do have to pay all of these fees inherent to the reverse mortgage. Things like the loan origination fees and the mortgage insurance premiums and the closing costs and all of these different fees that are associated, and they can really eat into the amount of money that you're going to take out. And the thing is, most borrowers actually pay for those fees from the loan that they just took out. Therefore, they're not only falling behind because they have to pay the fees in the first place, but they're falling further behind because they're going to end up paying the interest on those fees. And so what ends up happening is before you even know it, you've sucked thousands of dollars from your reverse mortgage. And the problem with that is since the reverse mortgage is only letting you tap into a certain amount of your home's equity, then what you're going to end up doing and what's going to end up happening is you will get to a point where the money stops. There will be no more money left in the reverse mortgage. And obviously that is not the reason that somebody would want to go about doing this anyway. And even worse, once you sign the reverse mortgage, once you start the reverse mortgage, your interest rate will creep up from the time that you sign it to any time in the future. The interest rate is going to continue up and up and up, so your costs are going to keep increasing and increasing and increasing, and that is a problem. And those advertisements that we were talking about at the beginning of the episode that you've likely seen on TV over the years, they like to tout that, oh, you'll never owe more than your home is worth. Well, that's just simply not true because of some of the interest rates that are inherent to these reverse mortgages. So let's use this example. Let's say your home is worth $200,000 and you take a lump sum $100,000 reverse mortgage, and the reverse mortgage interest rate were 5%. And let's say you're at the age of 62 at the time. Well, the total interest that would accumulate on that $100,000, if it were a 25-year term length of the reverse mortgage, would be $238,635. Obviously, more than the 100,000, but that's also more than the value of the home. And so you would end up owing at the end of the term or at death $338,635. And so at the age of 87, that's how much money you would owe to the bank, more than your house is worth. Once again, huge issue. So this means that the individuals that you're going to leave your home to and leave your estate to and your money to, they would be stuck with a $238,635 bill that either they would have to pay from the money that you did have, but I'm guessing since you took out the reverse mortgage in the first place, you probably didn't have that much in funds or adequate funds to leave them a ton anyway. But the chances are what they'll have to do is they will just have to go ahead and just sell the home in order to cover this amount. And that's a sad way to deal with a lot of progress that you made over time in paying on and paying off your home, likely before you got the reverse mortgage in the first place. And so instead of getting to this point where you have to take out a reverse mortgage, what you should do is you should probably try to go about decreasing other expenses, or even decreasing your housing expenses if you're still paying on your mortgage. Or let's say your mortgage is paid off, but you've got a nice home, all these types of things, but you're kind of low on cash. Something you may do is sell your home and decide to use the excess of the sell price and then the price of something smaller or less expensive that you purchase, and use that as income for yourself. And then you don't pay interest on those things, and you don't have to be riddled with fees and have to worry about your heirs not getting the money that they are supposed to be left in your estate. And so those problems don't come up if you just make some simple concessions. A lot of what the reverse mortgage is, in the same way of many other loans and many other types of debt, are the fact that you don't want to have to take responsibility for where you are at and your failure to either save, or your house poor at that particular time. So you don't want to take responsibility for that. Therefore, you just run to debt because it is easy. Reverse mortgages are easy, and we don't want them to be easy because they are not good ideas. And I just want to leave you guys with this. Even though they say that you shouldn't lose your home with a reverse mortgage, it is definitely possible. It is definitely something that could occur. And here's how. So let's say you're receiving these payments from the reverse mortgage over time, and that's coming in, and that's how you're paying for your life in retirement. And let's say you get to the end of that money and you're still going to owe property taxes, you're still going to owe homeowners insurance, you're still going to owe all these different bills and things. And how long until, when you have unpaid taxes and unpaid insurance bills and things like that, how long until somebody's going to come wanting to seize the property because you're not paying what you're supposed to pay? The answer is not way too long. So you can put yourself in a really tough place to where you do lose your home because you were relying on the reverse mortgage for your income, and then it runs out. These are very commonly pushed in a very predatory way, and that is no surprise. Like I said on the outset, and as I've alluded to previously in this episode, you see these things on commercials. And I've talked about several things already in my episodes to this point that people go on TV talking about, and they talk about on commercials, like life insurance and like gold and now like reverse mortgages. And it's a pretty sure bet that if they're having to put it on TV, if they're having to put it on and say that, okay, well, we have no other way to market to people, we need to do it to people who may be watching TV at a given time, and try to just get them in and get them hooked on something. And you notice that they market on these different channels and TV shows that are typically watched by the elderly. So you notice that gold is typically bought a lot by older people. Reverse mortgages, they have the requirement of being for older individuals, but they're typically taken out by older individuals. And then, insurance products are commonly taken out for individuals that are older. Same thing with Medicare products. They see those also for individuals who are older. So that is no surprise to any of us that would be the case and that they would try to do that. So just keep your eyes open for this type of advertising. Keep your eyes open for these types of products because they are not what's best for you in your financial life. We want to stay out of debt. We don't want to continue running back to it every time we think we have an issue. Maybe you need to work longer if you're 62 and can't afford your bills and have to take out a reverse mortgage. Maybe you need to downsize, like I said earlier. Maybe you need to make more income. Any of these types of things can help you get over the hump. And a reverse mortgage should not be the thing that you run to in your time of need. So hey guys, thanks for watching this video. If you could, go down below, hit the big red subscribe button, like this video, leave me any feedback down in the comments if you have not already. If you're listening on Apple or Spotify podcasts, make sure that you subscribe and leave me a review. Follow me on social media, all the social media platforms at MNO with Dylan. I think that'd be a really good follow and would help you in the way that you would get to see some supplementary materials that you don't get to see just in these daily episodes that are a bit more long form. That would be a shorter, more concise tips and tricks and things that you could get from my social media accounts. And then you can also sign up for financial coaching if you're interested on my website, www.mnowithdylan.com. You can click on the Work with Dylan tab and pick the financial coaching type that works best for you. So tune in tomorrow as I take something from today's episode and kind of push towards another episode. So tomorrow I'll be talking about home renovations and how they are very costly, but we can go about paying for them without going into debt. So thank you guys for tuning into this episode of Money's No Object. I'm your host, Dylan Howe. God bless.